Welcome to the January 2026 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by Mav. U.S. Federal Reserve Policy and Economic Outlook. The Federal Open Market Committee, FOMC, left its policy rate unchanged at its January meeting, as anticipated by market participants. Two dissenting votes emerged, with Governors Steve Moran and Christopher Waller advocating for a 25 basis point reduction. Mav noted his long-standing view that the US economy has demonstrated greater resilience than consensus expectations, as shown by third-quarter data exhibiting exceptional strength, while GDP Now forecasts indicate fourth-quarter growth could be in excess of 5%. The Federal Reserve's accompanying statement acknowledged solid economic activity and stabilizing unemployment rates, whilst noting inflation remains somewhat elevated. Chairman Powell's press conference emphasized that growth in labor supply has approached a halt, which Mav has previously characterized as a supply shock rather than a demand shock. This observation aligns with the view that migration policy is the principal determinant of labor supply growth in Western economies. Critical upcoming data includes the February labor market revisions, which may prompt a reconsideration of policy language at the March meeting if substantially worse than expected. The dot plot projections due in 6 weeks will be scrutinized for potential upward revisions of the neutral funds rate from its current low 3% level. Market-implied probabilities derived from federal funds futures indicated a negligible chance of a rate cut at the January meeting, with approximately 2 cuts priced for the year ending December. Following the meeting, these expectations remained essentially unchanged at 1.9 cuts, with the probability of a 25 basis point reduction in March increased marginally from 9% to 14%. SD highlighted that quarterly productivity growth reaching 4% on an annualized basis is a remarkable figure for the US economy. KS added that it should be noted the compositional effects, given that approximately half of current GDP growth is derived from capital expenditure. Mav noted that through-the-year labour productivity growth measurements showed progression from 1.2% at year commencement to 1.5%. Currently with 2% considered sustainable for the US economy. In the US, the Employment Cost Index, ECI, has moderated from pandemic-era levels exceeding 5% to approximately 3.5 to 3.6%, providing inflation offset capacity that Australia lacks. Mav expressed his ongoing concern regarding the trajectory of inflation despite the Federal Reserve's characterization of tariff impacts as transitory. The US situation contrasts sharply with Australian productivity growth, which remains near zero and requires substantial structural reforms such as a tax system overhaul and regulatory reductions for it to improve. A strong ABS labour market outcome in December meant that trend unemployment is now falling, and domestic demand for labour appears to be responding to the RBA's 3 rate cuts in 2025. Global market valuations and sectoral analysis. Risk assets across global markets are trading at elevated valuations, predominantly at or near the upper bounds of historical ranges, and reflect bullish market expectations. Mav emphasized that such price-to-earnings expansion cannot occur absent an optimistic forward outlook, contradicting recessionary scenarios. The quarterly economic summary distributed by Evergreen Consultants in early January detailed how key risk assets trade on rich multiples, and there does not appear to be any obvious value opportunities presently available. The 2025 investment thesis that growth-seeking investors required US exposure despite expensive valuations, while value-oriented portfolios benefited from exposures to Europe and Japan, played out as anticipated. This dynamic appears likely to persist through 2026, although geopolitical risks introduced by the Trump administration present challenges for asset allocation decisions. These include threats regarding Venezuela, Greenland, despite existing US strategic control, Iran, and a proposed 100% tariff on Canada should trade agreements with China proceed. Commerce Secretary Scott Bessent addressed Canadian relations, referencing the impending North American Free Trade Agreement discussions. Market commentary frequently also references late 1990s technology bubble comparisons, though it was noted that fundamental differences exist as detailed in Evergreen's paper from late 2025. Supporting factors for current valuations include robust earnings data with double-digit growth anticipated for 2026, while recent adjustments appear have so far been positive rather than negative. The three Federal Reserve rate cuts together with the additional fiscal stimulus anticipated are also expected to provide additional support. At a sector level, PE multiples look stretched for consumer discretionary, 29 times, and information technology, 26 times, based on forward earnings. SD expressed surprise at consumer discretionary's elevated PE, but KJ highlighted that consumer discretionary encompasses Amazon, Costco, and Walmart, all of which are currently trading on premium valuations. Financials trading at 16 times were highlighted as looking attractive relative to the sectors trading in the high 20s. The 22.3 times multiple for US markets contrasts with emerging markets at 13.4 times and Europe at lower levels. Though SD observed, these represent top-of-range valuations within their respective 20-year historical contexts, creating an illusion of relative cheapness. China's 12.3 times multiple represents a re-rating from lower levels. KJ suggested the US-China trade conflict may have limited impact given their complementary economic structures, with China's economy remaining manufacturing and investment-led, whilst the US economy maintains a services orientation. The US industrials sector premium likely reflects the inclusion of defense companies whose valuations are currently supported by elevated defense spending and an anticipated 50% increase in the US military budget. Small capitalization, performance and interest rate expectations. Small caps have seen a strong start to 2026, strongly outperforming the Magnificent Seven, which are down slightly month to date, whilst relative to the equal weight S&P 500 index, they have also outperformed. Small cap performance has progressively improved across small caps cohorts, with microcaps exhibiting the strongest returns. MAV interpreted this as vindication of discussions from 2025 regarding the optimal timing for small cap exposure, with the trend accelerating from the second half of 2025. Equal weight indices trade at less elevated multiples than their market cap counterparts, excluding pandemic distortions, and could be used to avoid concentration in the expensive megacap securities. This represented a potential portfolio positioning consideration for the committees later in the meeting. In relation to defensive assets, Australian interest rate expectations, as at 27th January, showed a 61% probability of a rate increase at the next Reserve Bank of Australia meeting scheduled for 3rd February. MAV had maintained throughout late 2025 that absent concerning quarterly data, no rate changes would occur during 2026. However, following the quarterly CPI data release, the probability had increased to 70% and remained at that level immediately preceding the asset allocation meeting. Markets now anticipate 2 rate increases by September, with MAV now concurring that one increase appears likely in either February or March, but this could potentially constitute the entirety of the tightening cycle. MAV referenced the December AAC guest presenter, Tim Toohey's December analysis, demonstrating that data distortions throughout 2026 would perhaps provide sufficient justification to cease hiking after one increase despite Toohey's original expectation of multiple cuts through 2026. KJ observed that domestic policy development has stalled at both federal and state levels, preventing necessary productivity enhancements within governmental control, though acknowledging private sector investment decisions also contribute. A comparison of US dollar-denominated Vanguard World Index, FTSE All Global, against MSCI Australia over the last 17 years reveals dismal Australian equity market performance, which KJ attributed to inconsistent policy reform rather than deficiencies, with the Reserve Bank of Australia effectively hostage to these structural constraints. Japanese monetary policy and Australian inflation dynamics. The Bank of Japan increased rates in December and paused at its January meeting as anticipated, with markets pricing 2 additional rate increases over the course of 2026. MAV identified this as a significant risk factor, expressing particular concern that inflation pressures in Japan, amplified by likely stronger fiscal stimulus following the calling of a snap election to improve parliamentary numbers for the implementation of its proposed policies, could necessitate 3 rate increases instead of 2. MAV highlighted the market response to the unexpected July 2024 rate increase, which resulted in severe volatility from the carry trade unwinding and could demonstrate the potential consequences of additional monetary tightening this time. The potential for increased Japanese rates could reduce demand for US Treasury securities, as Japan investors seek to bring their investments home. This dynamic contributes to upward pressure on US yields, as Japan is one of the largest owner of US Treasuries. MAV anticipates that this dynamic will intensify as the inflation picture develops. The term premium already exceeds 70 basis points and is expected to rise further, compounded by the substantial projected government spending regardless of political orientation. Japanese 10-year and longer-dated bonds trade at multi-decade highs. Relative value analysis supports preferring Australian duration over other markets, given their higher absolute yields, providing downside protection. Australian long-term real interest rates are now approaching 2.4%, which is elevated relative to recent history. MAV noted this typically would be unsustainable, but attributes the current levels to recent momentum. Should the anticipated rate increase materialize, a second increase would constitute an enormous constraint on the recovery trajectory, though MAV does not currently expect a second increase to occur. KJ concurred, observing real rates have increased from 1% in January 2023 to 2.4% currently, representing restrictive policy that would make additional tightening a substantial handbrake on economic activity. Australian equity market valuations appear excessive at 21 times forward earnings, with the dividend yield approaching 3% for a market historically characterised as income-oriented. MAV described Australia as a diversifier with selective yield opportunities rather than broad market appeal, given its current 3% yield, which is substantially below the 4.1% historical average. Relative valuations across multiple decades indicate the market is currently expensive, raising concerns that should the multiple rate increases materialize, this could precipitate a major fall in the market. KJ observed the commodities bull market has expanded beyond concentrated leadership, with price action in precious metals indicating strong monetary demand rather than industrial demand. Platinum outperforming palladium contradicts industrial catalytic converter demand patterns. Palladium is traditionally preferred for hybrid vehicles, suggesting monetary inflation drivers. This raises questions regarding whether zinc and other base metals movements reflect genuine industrial demand or broader monetary interest, with definitive signals expected during 2026. KJ highlighted that US copper demand has remained essentially stagnant over the last 20 years, with recent growth limited to data center construction, contrasting with the substantial Chinese demand coming from their electrification programs. Australian December quarter consumer price index data, which the Reserve Bank prioritises over the monthly series pending confidence in methodology, showed trimmed mean inflation at 3.4%. and headline inflation at 3.6%. The latest figures differ from the monthly series measurements and consistently indicate excessive inflation with sufficient 6-month momentum to warrant a policy response. MAV suggested the August rate cut likely should not have occurred despite the 2.1% headline CPI, which was distorted by electricity rebates. The monthly series calculations show 3.8% headline inflation and 3.3% on a trimmed mean basis. Both measures exceed the Reserve Bank research team's 3.2% year-end target. Goods inflation increased 3.4% annually, with electricity contributing 21.5%. Though excluding rebates, it would only show a 4.6% increase. Services inflation strengthened to 4.1% from 3.6% in November, driven by domestic holiday travel and accommodation increasing nearly 10% year on year. Rent, previously the primary inflation driver over nearly 2 years, shows signs of moderating. In relation to US inflation, the trimmed mean measures from the Cleveland Fed and Dallas Fed indicate just under 3% inflation, with personal consumption expenditures at 2.69%, December data pending. Despite the Federal Reserve's stated commitment to its 2% target, MAV believes they are actually targeting 2.5%, with concerns that any upward movement in these series would create substantial pressure on the incoming Fed chair to implement contractionary policy contrary to the market's current expectations. Investment market outlook and opportunities. Jim Cronis presented a comprehensive assessment of the global economic landscape for 2026, characterizing it as entering a period of synchronized and accelerating growth. The base case scenario, which was assigned a 65% probability in April 2025, has largely eventuated as anticipated. This scenario centered on the expectation that the Trump administration would pursue negotiated outcomes with trading partners rather than risk precipitating a recession, with US growth moderating to approximately 1.7% and the Federal Reserve implementing up to 75 basis points of rate cuts in the second half of 2025. These assumptions have played out, supporting a risk-on positioning rather than a defensive stance throughout the year. For 2026, Cronis outlined differentiated regional outlooks whilst emphasizing the overarching theme of global acceleration. The United States faces an unknown trajectory regarding tariffs and its relationship with China, coupled with efforts towards partial decoupling. The Australian economy is expected to demonstrate particular strength insulated from tariff impacts due to favourable positioning on critical minerals and rare earths. The US economy is projected to follow a substantially stronger path underpinned by policy tailwinds, including tax cuts, investment incentives, and a Federal Reserve that has moved to pause following a global rate-cutting cycle. Europe is anticipated to remain resilient, supported by 200 basis points of rate cuts implemented in the previous year, fiscal expansion, infrastructure spending, and increased defence expenditure, which is targeting 5% of GDP. These structural factors are expected to provide sustained growth for the European economy. China presents the most significant challenge, confronting what Cronis termed the dual pressures of a Great Wall of tariffs and persistent deflationary conditions. Whilst December export data showed strength at approximately 1.2 trillion, with reorientation away from the United States towards alternative markets, this strategy has limitations. China requires alternative growth drivers and is pivoting towards domestic consumption, with the forthcoming 5-year plan expected to focus on maintaining a 4.5% growth target through consumption-led recovery. The synchronized global acceleration is projected to drive aggregate growth from 3.3% in 2025 to 3.6% in 2026 on a purchasing power parity basis, with market prices approximately half a percentage point lower across all regions. Cronis maintained his contrarian view from April, which has now achieved consensus status, projecting Australian GDP growth to accelerate from a 2.0% run rate to approximately 2.8% in 2026. This optimistic outlook is predicated on several factors: favourable standing with the United States, acceleration through 2026, buoyant private activity levels transitioning from public sector dependence, and unemployment forecasted to remain at the lower end of their 4.0 to 4.3% range, contrasting with broader market expectations. The forecast acknowledges potential downside risk, noting that if net exports contribute less than anticipated, growth could be reduced by 0.3 to 0.4 percentage points, though the underlying trajectory remains materially positive. Regarding monetary policy, Cronis projects the Reserve Bank will commence rate increases, with February emerging as the most likely time. This represents a significant policy reversal from the 3 rate cuts implemented in 2025, with the potential for all three cuts to be reversed over a protracted period. Kronos's neutral rate assessment stands at 3.85%, above the Reserve Bank's revised 3.6% estimate. He acknowledged that traditionally, following a rate cut, policy reversal would occur after 6 to 9 months to preserve institutional credibility, which would have suggested May through July timing. However, market forces are compelling earlier action. The maximum number of rate hikes envisaged is 3 and would be designed to return rates to levels sufficient to moderate inflation without materially damaging the economy whilst maintaining full employment. Kronos noted that significant budgetary cutbacks from the federal government, potentially signalled by Treasurer Chalmers, could offset inflationary pressures and recalibrate the required number of rate increases. Currency, commodities, and sectoral earnings projections. The Australian dollar forecast maintained the 65 cents anchor established in April 2025 as the floor level, contrasting sharply with some market projections suggesting potential depreciation to the mid-50 cent range. As economic acceleration progresses and uncertainty diminishes, Kronos projects a strong upward bias, with the current assessment at 70 cents and potential for rapid appreciation of 2 to 3 cents, contingent upon reduced US political uncertainty and continued domestic economic strength. Commodity prices are expected to enter 2026 in a positive upswing cycle, with particular structural support for iron ore, copper, gold, and lithium. These positive structural underpinnings reflect persistent supply constraints from years of underinvestment in mining industries, alongside emerging demand from artificial intelligence infrastructure, electrification trends, and energy transition requirements. Ausbill's earnings projections demonstrate material divergence from consensus, though the gap has narrowed as market forecasts have been upgraded. As of the latest revisions, Ausbill projects aggregate market earnings growth of 15% for 2026, compared with consensus at 10%. The resources sector shows the most substantial differential, with Ausbill forecasting 36% growth versus consensus at 20%, upgraded from an earlier 15% projection. Industrials are projected at 9% growth compared with consensus just under 7%. For the utilities sector, Ausbill forecasts 4.7% versus market consensus at 4.4%, representing relatively balanced expectations. Banking sector projections show Ausbill at 5.0% compared with market consensus between 4.0 and 4.5%, reflecting expectations of modest but acceptable earnings growth. The environment is characterized as supportive of strong earnings growth, underpinned by nominal GDP growth rates that should prove favorable, particularly for resources exposure and, to a lesser extent, industrials. The structural commodity thesis emphasizes that underlying demand driven by artificial intelligence, electrification, and energy transition, combined with supply constraints from historical underinvestment, creates a favorable multi-year outlook. Kronos acknowledged that banking earnings would remain more muted relative to resources and industrials, though still acceptable within the context of the broader economic acceleration and supportive policy framework. Interest rate outlook and systemic risks. Kronos outlined differentiated global monetary policy trajectories reflecting regional economic conditions and inflation dynamics. For the United States, following the December rate cut, the Federal Reserve has moved to pause, consistent with Kronos's earlier assessment that rates had approached neutral levels. The neutral rate is estimated between 3.0 and 3.5%, incorporating assessments from former Chairman Greenspan and current Chairman Powell. The base case anticipates the Federal Reserve remaining on hold for the immediate to short term, with any bias favouring rate cuts rather than increases. However, Kronos acknowledged a 5% probability that strong growth and tight labour market conditions could necessitate rate increases, representing a tail risk scenario. If productivity proves substantially stronger than current 2.3 to 2.4% estimates, this could provide scope for 1 or 2 additional rate cuts whilst maintaining economic stability. European central bank rates are expected to remain on hold at 2.0%, having completed the 200 basis point cutting cycle. The Bank of Japan will continue hiking rates in 25 basis point increments whilst gradually reducing balance sheet assets, though this deleveraging process will extend over a prolonged period. Cronus emphasised the critical importance of monitoring Japanese government bond yields across the 10, 20 and 30-year maturities, as these serve as a bellwether for global bond markets. Japan's role as the world's largest creditor and capital provider creates direct linkages to US Treasury markets. With nominal yields and the yield curve having risen materially, and the yen having depreciated substantially against the US dollar, Japanese asset allocators face increased opportunity costs for maintaining offshore investments. This dynamic could prompt capital repatriation to Japan, reducing marginal credit availability to the United States precisely when the US requires substantial funding. With fiscal deficits running at 6 to 7% of GDP annually, debt to GDP approaching 100%, and 1/3 of the bond portfolio subject to rollover and maturity in the coming year, the United States must compete with Japan for capital, potentially driving yields substantially higher across global sovereign bond markets. China confronts the dual imperatives of managing the Great Wall of tariffs, whilst addressing structural and persistent deflation. Producer price index and consumer price data show 3 years of deflationary pressure, reflecting excess capacity that requires reduction. To achieve the anticipated 4.5% growth target, expected to be announced in March, China will implement expansionary fiscal policy focused on driving domestic consumption rather than export-led growth. This reorientation represents a fundamental shift in economic strategy, though success remains uncertain given the magnitude of structural imbalances. The most significant systemic risk identified involves potential de-anchoring of long-term inflation expectations from central bank targets as accelerating growth causes economies to approach supply constraints. This scenario would compel central banks to reverse rate cuts, with Australia positioned as the first to undertake such a reversal. In an environment of increased investment demand, term premiums embedded in long bond yields should rise from the current level of 70 basis points for US Treasuries, with potential to reach 100 to 150 basis points. Cronus identified a particular concern regarding sovereign debt dynamics, noting that whilst debt to GDP levels approaching 100% create challenges, the critical threshold emerges between 140 and 150% of GDP, at which point fiscal sustainability becomes severely compromised. Japan provides a cautionary example, where the new Prime Minister's snap election seeking greater parliamentary control to expand fiscal policy triggered rapid spikes of 20 to 30 basis points in 10, 20, 30 and 40-year bond yields. Given these yields traded near 10 basis points several years prior and currently trade in the mid-2% range, such volatility could spark a global rout in sovereign bond markets, representing the most substantial threat to the otherwise positive investment environment. Cronus assessed recession probability for Australia at approximately 10%, despite domestic policy challenges, due to the overwhelmingly positive global backdrop and Australia's fortunate positioning across multiple structural variables that should prove beneficial at this particular juncture. Economic discussion. The committee engaged in extensive discussion of the current economic environment, with particular focus on the Australian domestic outlook and global productivity trends. Following Jim Cronus's presentation, members expressed general agreement with his positive stance on Australian consumption growth, driven by the impact of recent rate cuts. Mav reiterated that he had observed material changes in household spending behaviour by July 2025, with the data confirming this shift through August. The committee acknowledged the presentation's quality whilst noting the analytical challenges around interpreting recent CPI data. Significant attention was devoted to the structural challenges facing Australian fiscal policy. The committee discussed Cronus's analysis, suggesting it could be mathematically impossible for Australia to reach the RBA's effective 2.5% inflation target without reversing rate cuts, given the dominance of services inflation and non-tradables. Members expressed scepticism about the government's capacity to make material spending cuts in politically sensitive areas such as Medicare and NDIS, despite these representing key levers for fiscal adjustment. The committee anticipated this would create significant social cohesion challenges in the second half of the year as any budget cuts are announced and implemented. The committee examined productivity dynamics extensively, with particular emphasis on the differential in AI adoption between private and public sectors. Members noted quiet workforce reductions already occurring at major technology companies and banks, suggesting a private sector revolution in productivity that has not yet manifested in official statistics. However, the committee expressed concern that public sector productivity improvements would face significant union and political resistance. The discussion highlighted the growing divergence in GDP per capita between Australia and the US, with members concluding Australia would likely remain a global laggard over the medium term, characterised by slow growth and low productivity, whilst avoiding outright recession due to ongoing resource sector strength and global economic resilience. Portfolio construction. The committee reviewed portfolio positioning and agreed to implement two specific changes whilst maintaining the overall 64-36 growth/defensive allocation. Members expressed general satisfaction with current positioning, particularly the preference for Australian over global fixed income given yield differentials and the existing tilt toward shorter duration. The primary focus centred on currency hedging in the portfolio. Given the outlook for higher Australian rates and lower US rates that should support AUD strength, members agreed to increase the hedge ratio modestly. After discussion about maintaining flexibility for potential further moves, the committee decided to increase hedging by adding hedged exposure within the existing international allocation. Members specifically noted the intention to preserve capacity for additional hedging should the US dollar experience more pronounced weakness than currently anticipated. The move took the hedging ratio from 36% to 42%. The second adjustment addressed the committee's conviction around the materials sector earnings growth prospects. Rather than direct sector positioning, members agreed to increase Australian small cap exposure by 1 percentage point from 4% to 5%, funded from the broader Australian equities allocation. The committee viewed small caps as an effective proxy for resources exposure whilst providing diversification benefits. This decision reflected the structural supply-demand dynamics supporting the sector and recognition that small caps would capture significant exposure to the materials earnings growth forecast. Members noted this represented a meaningful increase given the low base, whilst maintaining discipline around the appropriate sizing of the small cap allocation relative to its circa 20% share of market cap beyond the ASX 200.